Chart Watchers, good afternoon. Welcome to Market Watchers Live on Monday, September 16th, 2019. My name is Dave Keller. I'll be your host today for the next hour. Thank you so much for joining us today. I have always enjoyed watching Market Watchers Live with some pretty capable hosts, Tom and Aaron, walking through what's happening during the day and getting a sense of how it makes sense to me as an investor. And I hope I'm able to give you some of that today as well. Quick shout out to my parents, Rick and Joe Keller, their first time listening to Market Watchers Live today. So we have 2 new viewers, so congrats to them. All sorts of great plans get completely torpedoed over the weekend when new news comes out, and that is certainly what has happened with the energy markets. When you think about market dynamics and you think about what's moving and you think about where to look, one news headline seems to change things. So we're going to talk a lot about energy here at the beginning and just think about oil prices, energy stocks, how they're all related. Let's do a quick check on the markets before we get too deep into there. So stocks, broadly speaking, in the U.S. here down, the S&P down about 50 basis points, coming off of a pretty good week last week. The NASDAQ leading a little stronger to the downside, and some of the small cap names actually doing fairly well. Going down to some of the major indexes, you have small caps that are actually flat on the day now, the S&P 600, the mid cap index also flat, but the larger names, the biggest names, the mega cap names, the S&P 100, Dow Transports, this is what is dragging down markets today, and energy sort of at the upper end of that. We see that looking at the sector rotation here, and in the short term, of course, it's all energy today. Later in the week, we'll get into the Fed and plenty of headline risk and headline catalysts for stock movements, and that's when I would argue is the best time to look at your charts and get a sense of what levels and what signals are of most meaning to you. But so far today, we have energy, real estate, utilities, a real defensive rise besides the jump in energy. On the downside, you have all the consumer sectors, including staples and discretionary, both down. Discretionary down a little bit more, and that's going to make that key ratio, the consumer discretionary versus staples, come down just a little bit this morning. Communication services down as well. Looking at some of the industries in play, it's all energy at the top of the list here, obviously, with oil jumping 10%. That's where we're going to see the gainers, and it's really skewing the rest of the returns on a relative basis here. So no surprises there. But at the bottom, that's kind of interesting. Airlines, one of the worst groups so far today, and retailers as well. So we're going to look a little bit at airlines, I think, when we look at some of the scooter movements and scooter ranking changes, because airlines are some that have jumped very quickly in a short period of time. I always find that to be sort of an interesting thing to pay attention to. Thinking about the upcoming schedule here, we've got a really good lineup coming up here. Tom, who always does a really good job with his workshops, really digging into his head, is always such a good opportunity. That's coming up tomorrow on Tuesday. On Wednesday, we have Dave Landry, and I'm going to share in a little bit. This weekend, I was at the TSAA Conference in San Francisco. Really cool experience, really good group of investors and market experts, and Dave Landry was one of the speakers. He did a really good job talking about not just how to think about stops on your trades, but also the mental game of trading. We'll talk about that in a little bit. But he's going to be here as my guest on Wednesday when I host. Thursday, we have the sector expert, Julius de Kempenaar, coming in to share his inputs. And then I'll be hosting again on September 23rd, next Monday. And I twisted my colleague's arm, Grayson Rose. He agreed to come on. There's so many cool things coming up with the StockCharts platform, and Grayson is better than anyone to sort of share what's coming down the pike. So it should be pretty interesting. So I have not hosted Market Watchers Live on my own very often. This is actually the first time I've done it solo. So we had a really good time thinking about what sort of news, what sort of segments could be of interest to you. And a lot of the things that we're showing you here today will most likely be incorporated into my new show, The Final Bar, which is the new Closing Bell show, which starts 2 weeks from today on September 30th. So make a note of that. Every day at the right at the close at 4 p.m. Eastern, 1 p.m. Pacific, we'll break down the trading action. So some of the things we're gonna go through today. Going to introduce the mystery chart. The mystery chart, after we talk about some of the headlines, we're going to get into what I call the mystery chart. One of the ideas was to share something, a chart, an indicator, a tool, and not tell you what it is. Have you think about it. Guess what you think it might be, and then we'll come back later and sort of give the answer and why I think it's a key chart to pay attention to. So it's not just a random one. It actually, I think, has meaning for you. Then we're going to talk about the TSAA Conference, as I mentioned. We're going to break down the experience that I had. There were some really good experts like Craig Johnson from Piper Jaffray, John Lewis from Dorsey Wright, Robin Mesh, Greg Schnell, our own StockCharts expert. We're going to break down some sectors and two things I want to point out to you very quickly, thinking about the sector outlook and also the 10 and 10. We have the poll open. It's been open actually since Friday. It's been open all weekend, so I'm interested to see what people have said. But I've asked you to make your suggestion of where you think what sectors are going to lead, where should sector leadership come from through the remainder of the year. So if you haven't had a chance to go into that poll, can you please do it real quick? And just a little bit about midway through the show, we're gonna look at the results of the poll, talk about some sector rotation. And then for the 10 and 10, as always, if you go into the chat room and put whatever tickers you'd like us to look at, we can take some of those. And the more that you vote for different ones, the more likely it is we'll put them on air here. And the first one, due to popular demand, is DuPont, ticker DD, and we'll go through that. Then we will reveal in very dramatic fashion the mystery chart, show you what it is and why it's of interest to you. That'll be it for an hour. It should be a pretty cool run through the world of charting here from a technical perspective. So thinking about the markets, right, this has been a really interesting stretch. I'm going to show you the daily chart of the S&P 500, just refresh it here very briefly. This is a really interesting time, not just for the headline risk. And again, the oil shock that we've had today kind of came out of nowhere. I was at this conference Saturday morning, and the first speaker, Craig Johnson, said, well, there's been a drone strike, and we're all looking at each other like, what? Like, we just had our coffee, and we're not prepared for that. So it shows you how quickly these headlines can come out of nowhere. So I'm often asked, why should I be looking at charts when it's just news headlines? It's Twitter, it's oil news, it's all the Fed, and that's what's moving markets. I would tell you this is the time. This is the best time when everything's just kind of normal and there's not a lot happening. Charts are good. But when things are happening, when things are moving, oil doesn't just move because it moves. It moves because of all the investors, what they're thinking and what they're feeling, and being able to quantify that through the charts is what's so important. So this chart of the S&P 500, really interesting right now as we've rallied into this, what I'd call a supply area. And, as we get more familiar with each other, when I talk about a supply area, it's essentially an area of resistance. It's an area when the market gets up to a certain range, you'd expect selling, you'd expect an exhaustion of buyers or an entrance of sellers because of how much has transacted around these price levels before. So again, I'd call that a supply area, a level at which I'd expect supply to come in, meaning some sellers are willing. And so far, what we've seen today, and obviously again, a lot of reasons why stocks are down a little bit, but the S&P back below 3,000 as we sort of digest the news from over the weekend. The question right now, and what we were all talking about at this conference over the weekend, is what's next? Where do we go from here? And what's undeniable, even though there are plenty of stocks that are in great setups, there are also plenty of stocks that are relatively weak, that are struggling. But the fact that the S&P, the broadest market of U.S. equity exposure, is right at a congestion area, right at an area of resistance. It spent a lot of time there back in June and July, in the middle of the summer. Now coming back to that range, I would be incredibly surprised if we go dramatically further above that high from July, and that's just based purely on the fact that we've rallied back into this area of resistance, this congestion area, this supply area. So again, the price is what's most important, and what I would be looking for, just so we're all clear, you look for what the price does if it comes off a little bit, right? As we come down to the 29.55, 29.60 range, we have the upper end of this gap from the beginning of September that I'm pointing out. That's really the line in the sand for the S&P 500. As long as we remain above there, we're doing just fine. We're holding in okay. But again, I would not be surprised if we come back in and start to test some of these other levels. So I drew these Fibonacci retracements back here when we rallied from June to July, and I've had them on my chart for the last 6 weeks or so. I'm not removing them anytime soon because I think these are still really important levels to watch. And you look at how the range from August really fit into there. So overall, again, based on the broad equity, the equity chart, the S&P 500 up into that congestion range, which I think is really telling. Looking at some of the other benchmarks of interest, this is one of the candle glance charts that I like to look at, just looking at the broad equity indexes. And for me, this is sort of the 30,000-foot view, just looking at patterns and how they move relative to one another. So I'm always interested to see what is up against resistance, and transports probably jump out at me as being really clearly at resistance. Besides the S&P 500 up at previous highs, the transports at a really key area. Now, transports actually have a number of very unique and separate groups. You have things like railroads, which arguably long-term are some of the better charts out there anywhere in the US. I mean, some consistent outperformers, but you also have airlines that have been really volatile, really challenged. And again, we're going to look at airlines in just a little bit when we look at some of the movements in the scooter rankings. But transports as an index, I think, are really compelling here. It's at resistance, and it would take a lot to get above that previous resistance level. The sell-off that we're seeing in airlines today might be maybe the beginning of that further weakness, but that remains to be seen. This is also a place where I like right here in the bottom left to look at the mega caps, the S&P 100, the mid caps, the sort of middle of the range, and then the small caps. And what's really interesting, for a while I've been talking about the relative weakness in small caps as being one of the bullet points in sort of an overall bearish thesis, or definitely more of a cautious thesis. But boy, you can tell that has changed in a big way, right? So small caps have broken above resistance. We're going to zoom into the chart here very briefly. Has not gotten above the key resistance level, and that's why I'm not declaring an all clear, life is good, go and buy whatever you can, because this resistance range from February and May, I think, is really, really important. Lines up from the highs we had at the end of last year before the overall market sell-off. Until we get above that level, I think you have to be a little more cautious, a little more steadfast in what you're doing. This is a really good place to look at the U.S. versus non-U.S. markets, and that ratio has been a really key one. The U.S. has been leading for the longest time. That is arguably starting to change, and one of the important themes I think we all might have to deal with through the remainder of the year is the relative weakness, potential weakness of the U.S. versus global markets. This is one way to look at it, just looking at the S&P 500, again, testing sort of these all-time highs, significant highs, but you look at EFO, which is global developed markets, look at EM, which is emerging markets, and you can see that all three of these are up against significant resistance levels. EM, a little hard to see here, but if we zoom into the chart, you could draw a trend line from that high from 2018. This is a weekly chart here. Connect that to where we've seen highs in 2019. We're right about at that level, and that a break of that trend line resistance, I think, would be really key. On this, on the smaller chart here, just sort of this line that I'm drawing with the mouse. Frontier markets looks very different, and just to talk very briefly about that, a lot of people ask me about frontier markets, and at times it has emerged as being one of the incredible leaders. And in the beginning of the summer months, I mean, look at how it rallied when most other global markets were really struggling. You're absolutely right. Frontier markets have tended to be low correlation with the rest of the equity markets, which is important. However, you have to remember that the FM ETF in particular actually gives you a very narrow exposure, and the only reason is because a lot of those markets aren't incredibly liquid. So you're getting exposure to a small number of like Middle Eastern banks and things that actually are liquid, also have tradable data that you can track. So right now, frontier markets have underperformed dramatically. The ETF has. Overall, I think there are plenty of opportunities within there if you can get exposure at the stock level or at the country level. But as a broader measure of overall strength and weakness, it's a little challenged right now. I want to finish off this breakdown. Let's get into energy. We're going to talk about energy stocks, and I think what's most important to remember is big jumps, I think, are the best time to be looking at the charts here. So in the form of the USO, this is the the US oil fund, the ETF that tracks oil prices pretty well. There's never a great pure read on oil, but this is as good as I think you're going to find. The jump that we've had in oil, looking at the USO, we're right back up to the highs that we had in July. So, on Friday, we were down here 1145, 1150. We've jumped all of a sudden to 1271. That's a huge jump, and the standard crude oil benchmark up about 10% when we wake up this morning. So the question now is, what next? And I think when you're looking at the chart of oil, when you're looking at the USO, you want to look at where we're at. Always start at the current bar, the final bar here in yellow. Look back to the left and see where we're at relative to those previous levels. You'll note that today we are trading just above the resistance from July. And I think that's really key where we close today. Also tomorrow, what sort of confirmation we may or may not be getting there. So what you want to look for is where we are relative to those previous highs. At this point, we haven't really, we've traded above, potentially going to close above, but not quite there. We're also testing resistance from this Fibonacci level, the 50% level, which is taking it from the high in October to the low in December of 2018. So right now we're at the midpoint of this range. We have a lot of key resistance and support levels to deal with here. At this point, it's all about digesting this rally and then seeing where we're going to be at relative to that. So that is a quick rundown through the markets. There's so much we could go through here. I want to jump really quickly and show you what the mystery chart is, and then we're going to take a quick break, come back with a discussion of the TSAA conference that I attended. If you look at your screen, this is the mystery chart of the day. And again, my question to you, what is this chart? And I will save you a little bit of headache. This is a U.S. stock. It is something you have probably heard of. I will not tell you the sector or anything else about it. If you're intuitive, or if you're smart and can look at the price range, you can get a basic idea of what it's not by what price level it's at. But if you can look at this, actually being a pretty consistent relative winner, a nice solid uptrend type of chart you probably want to be aware of. So my question to you is, what is this chart? We're going to take a quick break. We'll be back shortly to debrief on the TSAA conference. Back with Market Watchers Live. Thank you. Hello, everyone. Welcome back to Market Watchers Live. This is your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com, coming at you from the global headquarters here in Redmond, Washington. Thanks again so much for joining us. There's a great chance midday to sort of take a step back, see what's moving, see what's happening from a technical perspective and what it means for you. However, I would say my best learning experiences, my best growth as an investor, as a technical analyst, has come when I have had the opportunity to take a step back and take a deep breath and learn about the markets, to learn from others that have done this before me. And I had a chance this weekend to go to the TSAA annual conference down in San Francisco. Now, if you're not familiar with the TSAA conference, this is the San Francisco-based technical analysis conference. Actually predates the CMT Association. This organization was founded in 1970, 1971, around that range, before the CMT Association that I've been very involved with for a number of years. And it was a really cool chance to learn from a couple of really capable speakers. And just running down very quickly, people like Craig Johnson, who's the technical analyst at Piper Jaffray. And as a quick teaser for our closing show, the final bar, we're actually going to sit down with Craig at his trading desk in Minneapolis next month, and we'll share some great insights from him. We also have Dave Landry from DaveLandry.com. Dave's going to be having a show on StockCharts TV very soon in the next couple weeks. So I got to pick his brain a little bit. And others. I want to go through each of the 5 presenters and just their main takeaways, because it was such a really cool learning experience. And again, if you're not familiar with organizations like this, the TSAA, the CMT Association, I definitely encourage you to take a look at these. These are the chance, looking at charts day to day on your screen are how you become, get better returns. But taking the time to meet other investors at an event like this, that's how you really grow as an investor over time and get better returns for the long term. So the first speaker was Craig Johnson. He's the technical analyst at Piper Jaffray, which is a broker-dealer based in Minneapolis. Did a really good job, as always, breaking down the markets from a long-term perspective. He spends most of his time working with institutional investors, so money managers, portfolio managers really around the world. So we talked a lot about the broad equity universe and sort of his take. Showing you a weekly chart of the S&P 500 right now, just to show you where we're at. His publication, he puts out a monthly book. I have it over here in my hand, and I know you can't see it, but this thing weighs a ton. And every month, him and his team, they put out this 200-page odd chart book breaking down all the price action. And he shared some of the wisdom from there. But the title is basically Danger Zone. And he had a number of Top Gun references, but it's essentially saying we're in the danger zone. We're up in resistance. His year-end target is 27.25. And on this weekly chart of the S&P that you see here, that's the horizontal blue line that you see. Which, as you can see, is well below where we're at right now. That's probably 8 or 9% below our current levels, doing the quick mental math. And it's right at the lows from earlier in 2019. So needless to say, a sell-off of that magnitude would be pretty painful. He's had that objective for quite a while. And this is earlier. This is at the beginning of the year when the market was well below it. So we've fluctuated quite a lot. But he is sticking to that thesis. And for him, it's all about the seasonal weakness. It's all about the fact that September, October tends to be pretty painful for stocks, which is totally fair. He also does a lot of really cool proprietary work looking at what he calls the micro groups, which he is, his team over decades has handcrafted these industry groups that break down all the U.S. markets from every angle you can think of, regional banks in particular parts of the country, et cetera. And the breadth of that is essentially turning negative. It's not as positive as you would expect at this point in the cycle. It's not giving you a screaming buy. It's a little more painful. So overall, definitely more cautious, but a really thoughtful presentation about the markets, which I thought was excellent. Second presenter we had was Dave Landry. And again, if you're not familiar with Dave, this Wednesday on this show, I'm going to be hosting again. We're going to have Dave on as a guest. He agreed to give us a quick preview of what he's going to be doing on his show on StockCharts TV starting next month in October. I'd really encourage you to pay attention to that one. He does a really good job of thinking of the markets, not just how you trade and how you get better execution as a trader, as an investor, but also he loves to think about how you think. And he does a great job of simplifying the markets, but more importantly, digging into the psychology. So me, if you know anything about me, I write the column called The Mindful Investor. I love to talk about mindfulness and mental preparation. So he and I spent a dinner together just, debating different topics about, trader psychology and how we think. And I'm really excited to have him on Wednesday. One of the things he talked a lot about was just the idea of stops and how important stops are as an investor, as a trader, regardless of your time frame. And he was talking about some of his tools, uses average true range. There are a lot of different ways, as you probably know, that you can do stops. On StockCharts, we have what's called the chandelier system, the chandelier stop system, which if you're not familiar, I'd encourage you to look into it. I'm showing you an example here with Home Depot. But essentially, it's a whole system based on average true range that allows you to stay with the trade that's working and get out of a trade that's not working, and just not have to worry about when do I take profits, when do I get out of something. It's when you violate the chandelier system, that's when it tells you to just start to revisit your position. So things like this are tools that we have on StockCharts.com. You probably aren't using enough as you could. So if you're not familiar with that specific indicator, take a look at Chart School for the chandelier system and look at how it might help you do a better job of getting out of winning trades, making sure that you're getting out and taking profits when you should. The third presenter is someone that you may not be as familiar with in terms of his name, but I tell you what, he is an incredibly intelligent, thoughtful investor and has had a pretty impressive career. John Lewis is at Dorsey Wright. He's based outside of Los Angeles. He lives in Pasadena, and we had a great discussion. He presented the momentum trading system, momentum investing, why it works, what are the challenges of following a momentum-based system. And John, I would consider a technical analyst, but I would also consider him a quantitative analyst, a quantitative investor. And many of us get very caught up in the subjective analysis of charts, right? Looking at charts, thinking of the price movements, executing based on our interpretations of the charts. And don't get me wrong, there's plenty of alpha, plenty of returns that can be made that way. John does it a very different way. He does a very systematic methodology, and him and his team, he's the one that runs a number of the momentum-based ETFs that you'll find from Dorsey Wright. If you look for those, you'll find the data on them. They do a really good job of quantifying momentum. Now, when I say momentum, it's essentially trend following. And that is the idea of investing or sticking with what has worked and getting out of what has not worked. And he reminded me of one of the great lessons I've shared with people about mean reversion versus trend following. Some people say, well, I like to buy weakness and sell strength. Others say I like to follow trends. How can we all actually make money? And the answer is based on our time frame. So if you have a shorter term time frame, what I would call a couple days to a couple weeks or anything less than that, you really want to be betting on mean reversion. And this is a chart of the momentum ETF, the MTUM ETF, but any chart is fine. You'll see in the short term, there are these fluctuations, right? So from the market bottom in 2019, as the market was in a cyclical uptrend, you can see this pattern of higher highs and higher lows as the market goes higher. Each one of those highs gets successfully higher. Each one of the lows does as well. The trend overall was positive, right? We went higher over this 6-month period. But in the short term, there are plenty of periods where the market mean reverted, right? If the trend overall is in the middle of this price range, we had periods where we were a little on the upside, a little on the downside. So as a mean reversion specialist, as a swing trader, you're trying to identify those short-term peaks and valleys and when we're a little too far from the longer-term trend. And that's why that works. That's why a short-term RSI or something like that tends to do really well for you. However, if you're a longer term investor and you're betting on mean reversion, you would get absolutely killed if you sell all of these rallies in the momentum ETF, right? Every time it comes up, if you're selling those as a long term investor, you're getting killed because it just keeps breaking to new highs. So as a trend follower, if you're looking a couple months to a couple years, you really want to be focusing on what stocks, what sectors, what groups are working, and get out of the things that are not working anymore. And if you do that, you're going to benefit from what's called the momentum factor. And if you go to the French website, right, the FAMA French model, he has actually, tracked data on factors going back decades. You can capture the data on your own. You can run your own tests on what's happened. But two fundamental or quantitative factors consistently have outperformed, even as people have become familiar with them. Momentum is number one and value is number two. And what that means is overall, if you buy stocks that are working and if you buy stocks that are undervalued, all else being equal, overall, you're going to do better than an index fund. You're going to do better than the overall market. So a lot of the technical toolkit is bet on this factor overall doing pretty well, right? Doing very well. So it was perfectly timely when John got up in front of the room, talked about momentum and how it works. And of course, this is over the last 2 weeks, the momentum factor has actually struggled in a big way, right? As some of those growthy tech names have come off a little bit, some of the more conservative stuff like financials, utilities, maybe real estate have emerged as leadership and have outperformed. The momentum factor all of a sudden looks like it's a total dog, right? It looks like it's coming down a little bit. His answer is yes, as a momentum investor, you have to deal with aggressive drawdowns, right? So you overall are going to have better returns. You're going to have to deal with some really painful periods in the short term. And that is by definition part of it. And what happens is a lot of times at inflection points, when the market rotates a little bit, you're going to be sticking with some names that have worked that start not working. And the names that have been beaten down, like energy that starts coming up and doing really well, you won't be there yet until it starts really building a track record. So, paying attention to that leadership rotation is important. As a momentum investor, you're going to be caught off guard in the short term, but overall, this has worked very, very well over multiple cycles and decades. So John's presentation was really good. It was a good reminder that looking at charts and being a trend follower over that 6 to 12 month to 2 year period is a really good way to make money over the long term. The next presenter was Robin Mesh. Robin has been a friend of mine for a while. I actually edited a book in 2007, 2006, something like that, called Breakthroughs in Technical Analysis. And Robin actually very nicely agreed to write a chapter. Her specialty is in market profile, which is a discipline that was created by Pete Steidelmeyer many years ago. And she studied with Pete and has evolved his system. There are a lot of ways. It's essentially the idea of looking at price distribution. On StockCharts, the tool I think we have that represents what she was talking about most effectively is this volume at price overlay. And if you're not familiar with it, just at the bottom, you go to the overlay section, do volume by price, just pop it right on there. What it's going to do is add this histogram to the left side of your chart. It's a really cool visualization of the distribution of the prices over this time period. So it shows you how much volume, how much time, how much volume has been executed at all these different price levels. And it gives you a visualization relative to the regular bar chart. And it shows you where the support and resistance is probably going to be. Now, why I think this is helpful on a chart like Royal Caribbean, if you're not familiar with the cruise lines, right? This stock has come down aggressively over the summer when the market's coming up, holding up just fine. This stock has just been getting crushed, and here's the relative performance. You can see the weakness over the last couple months. It's popped up just a little bit, but if you look at the distribution, look at how much time, how much volume was around this 102 to 104 level. That lines up really well with these support levels. So a number of times when the stock has sold off, it's found support around these levels. So it was no surprise as the Royal Caribbean sold off here at the beginning, mid to the point of the summer, we found support around those previous lows. If we do sell off, you have to look at this. I call this a demand area, an area where buyers have traditionally come in. But this visualization shows you that very quickly. It also shows you a concentration of resistance, and that's where Royal Caribbean would be if it appreciates a little further, getting up to this range where it's found resistance before. The final presenter out of the five was our own Greg Schnell. Greg does a fantastic job. His show on StockCharts TV is excellent. And if you have not seen his show before, I'd encourage you to tune in. And also go to the YouTube channel for StockCharts TV, and you'll be able to look at some of his previous episodes. They're really, really well done. And he, as the Canadian technician, focuses on a couple things. Really good focus on energy. So I'm dying to know what he thinks about all the movements here. But he also focused on the PPO indicator, and that's what I'm showing on the chart here. It's very similar to the MACD indicator, the moving average convergence divergence based on exponential averages. If you're familiar with that, this is identical in terms of the interpretation. The numbers are just different because it's based on the percent movements instead of the price movements. So it does a really good job. But he showed a bunch of weekly PPO charts, and something like Boeing that has just given a buy signal from the weekly PPO. Look at the sell signals here, beginning of 2018, the buy signal going into the beginning of 2019. Look at the real simple swings that it's given you on the weekly chart. Overall has now rotated over the last couple weeks to more of a buy phase for the PPO. So my two takeaways from Greg's presentation: number one, I need to use PPO, the indicator, way more than I have. The second thing is he is an expert on the chart list features of StockCharts, way better than I am. And so I actually took a bunch of notes of how to break down sectors, how to do different things using PPO and other indicators. So boy, if you're not super comfortable using the chart list feature, I'd encourage you to watch how he gets around the system, because it's pretty powerful and pretty cool to watch. So that was a rundown of the TSAA conference again that I was able to attend over the weekend. And again, if you're not familiar with organizations like the TSAA or the CMT Association, I sure hope you look those up and go to conferences like that. The more people that are there with different life experiences, different backgrounds, that's where we really ends up being a great discussion of the markets and what we're all seeing. Next, I want to talk about the poll, and hopefully you've had a chance to go into the poll and share what you're seeing. What I've asked you, and I started the poll over the weekend just to see if I could capture some lurkers on the StockCharts TV channel to share their wisdom. So thanks everyone that is answered. If you haven't, here's your last chance to do it. What I asked you is, what's the top performing U.S. sector in your opinion for the remainder of 2019? Now, of course, a lot has happened since I first put this up. We've had oil jumping. We've had the news over the weekend. We have the Fed coming up on Wednesday with a potential market shock there. So the open-ended question is, what's gonna work? So let's look at the results here. Interestingly, technology number one, with almost a third of you saying tech is going to be the leading sector. That is a really compelling answer. That's more of the traditional offense. That's something that's done very well, obviously, on a relative basis. It's been one of the top performers. And boy, if that would continue, we'd rotate back to technology, it would be hard. I would be hard pressed to think that the market isn't going to rally pretty dramatically from there. So I can only assume there are a number of you that are fairly bullish if you're voting on technology to be number one. Number two is energy, and I wonder how many of you would have answered that before all of this has happened. But good for you if you did. Points for Greg Schnell, who had prepared his presentation over the weekend, well before the weekend. He was talking a lot about energy names, and again, he's based in Canada, so focuses a lot on energy, on materials. But he did a great job of talking about the weakness in energy and how they probably could pop up very quickly from there. Boy, if energy would lead, talk about everyone being caught off guard. Craig Johnson, who spoke again yesterday, he's from Piper Jaffray in Minneapolis. What's cool about talking with Craig is he spends a lot of his time with institutional investors, big money managers at the largest money management firms in the world. And so hearing what he's hearing from his clients is obviously very, very telling, very interesting, because that's where a lot of the momentum can come from, right? If the big institutions are rotating. His comment is, as he's gone over the last couple months talking about stocks, talking about sectors, when he starts bringing up charts of energy stocks, do you know what his clients do? They say, no one wants energy. I don't want to look at energy. Let's move on to what else do you have? And he said, as a contrarian, the fact that energy is so off everyone's radar, that's a really interesting signal. And he's right. If the energy trade would start to work, which arguably it's starting to, in last week into this week, if that continues and you see those stocks continue to rally, as an institutional investor, you will have to be there. You will have to get into that trade. That's going to provide a lot of potential upside there as well. At the lower end of the range, I'm a little bit surprised to see all the consumer sectors down there toward the bottom. We have some non-believers in the retail trade. Good for you today, because retail's down in a big way. But overall, again, it's interesting. If the market would start to get its legs back, if it would start to move to new highs, you'd see leadership most likely from technology. You'd also see some really good charts in the consumer discretionary space. Home Depot, I showed you earlier, charts like that are going to start to work restaurants and others that we might be thinking out of the radar would start to work as well. Consumer staples, not a lot of love from you. And boy, utilities was the bottom. I asked our producers if I could put all 11 sectors. They told me that was a little too much for a poll, but fair enough. We got a good read from tech down to utilities. Let me share my screen again here, and we're going to look at the relative rotation graph, right? So I know you're familiar with Julius DeKempener's work. Julius does a really good job of breaking down sector rotations. This is one of the main go-to charts. I have a morning routine, and if you've not seen that clip, go to the YouTube channel for StockCharts TV. You'll see what's called the morning coffee routine. I was on a couple months ago, just sort of walked through how I use StockCharts first thing in the morning. I can't tell you how crucial that is for your process to have a good routine with your cup of coffee first thing in the morning when you're looking at the charts. And the RRG, the relative rotation graph, has always been a part of that routine for me. And the reason is because I want to get a good read on sector rotation. I want to know what's working and what has been working, what has not been, and what sort of movements I'm seeing. Looking at the weekly relative rotation graph, which is sort of my go-to technology, that again, a third of you, and again, you absolutely may be right. I do not have a crystal ball, but you might be right on the XLK being leadership. It has been the strongest sector on a relative basis for the longest time, and all of a sudden has not been, right? So it's down in the weakening quadrant, going down into the left, and directionally, that is the sign of weakness when it's going down toward the lagging quadrant. So consumer discretionary here, the XLY, XLK, the technology sector, all rotating down into the left. That is not an encouraging feeling. And again, that's digesting a lot of the movements that we've seen recently. If you look at what has been working, according to the RRG, it's consumer staples XLP, which is the strongest sector on a relative basis, just in the last 2 weeks, rotating down to the right. So if we would continue to rotate lower, boy, that would tell you a little bit of the unwind of staples leadership. But overall, it's been okay. Real estate here, the XLRE, and then utilities, the XLU. Look at how those have emerged, coming from the period or the area of weakness, coming back to an area of leadership. So the fact that real estate, XLRE, is potentially the most attractive chart or sector on the relative rotation graph work, I think is really pretty compelling here. Let's jump back into some of the sector charts here to wrap up this discussion of sectors. And thanks again, everyone, for voting on the poll. I love the interactive nature of StockCharts TV and the fact that I'm able to hear what some of you are thinking. That makes it a pretty cool, dynamic discussion. As I'm looking at the sector share, I've got the 11 sectors and just the S&P at the bottom. When I look at the candle glance charts, a lot of times what I'm trying to get a sense of is how these things are moving relative to one another. And I know how they're moving intraday. So I know that the consumer sectors, discretionary staples, you can see the yellow with the final bar here on the right. You can see how that's coming off a little bit. You can see how energy has gapped higher, trading down a little bit. But just take a step back and look at these peaks and valleys over the last couple of months and get a sense of what's moved higher, what's been stable, and what's had lower highs. And what's really interesting, what jumps out at me, which sectors have had higher highs, meaning from the peak we saw in July and August to the peak that we saw most recently at the end of August, beginning of September. What's moved to higher highs? Staples is actually the first one that jumps out at me. Industrials, the XLI here in the middle of the screen, you can see is at a higher high. What else? Utilities here with the peak in July, the higher peak at the end of last month, and then also real estate. So those are the four sectors that have had a higher high. So again, not guaranteeing that those are going to be the leadership going forward, but it's a reminder. And the reason why this is on my in my morning coffee routine is just to realize what's had higher highs, what's actually been in a cyclical uptrend that I need to be aware of. What's interesting right now with the chart of staples, just jumping there in there very quickly, you can see we're testing the most recent swing low. And that's always a little bit of a dangerous time. I'm going to zoom in just a skosh so we can see that. You can see when we start breaking through the most recent swing lows, that's when you have to be a little concerned in the short term. So in my opinion, in the short term, staples, the XOP is on sort of a red flag correction watch, just seeing if it's able to hold those previous lows or not. What has actually had a relatively stable peak from the high most recently to the previous high over the summer? Communication services here on the upper left is the first one that jumps to mind. Consumer discretionary, the XLY as well. Again, a little bit of a lower high, but overall I could say it's pretty stable. Financials, look at how that's come back to its previous high very, very nicely. Materials, I would argue, sort of in that range as well. So out of the 11 sectors, 4 of those, right about maybe just a little low, but not too bad. Those are the ones that are right at their previous highs. So again, for me as a long-term investor, until something like communication services is able to push through, muscle through those previous highs in a way that I can buy into, I have to be skeptical. I have to be a little bit cautious as to what's going on. So those top two, the communication services and also consumer discretionary, I think are really key to watch here. And also consumer discretionary, keep your eye out for that previous low. That leaves us with technology and with energy and with healthcare. These are the ones that are nowhere near or have had a lower high. Those are the ones that are struggling a little bit. And that's why I think technology, I know a number of you have said that that's going to be the new leadership. Boy, if that emerges, you are absolutely right. That's going to be a pretty strong trend to buy into. But overall, we have to be a little cautious. Energy, of course, is the big one to pay attention to. We're open much higher, gapped up on the day, now trading a lot lower. So I think that's one to pay attention to, the XLE. Thanks again for participating in the poll. As always, let's get right into the 10 and 10. It's one of my favorite parts of the show to pay attention to the 10 stocks that are of interest to all of you. Bringing on one of our producers, Rachel Ackley. Rachel, thank you so much for your help. I appreciate it.
Happy to be here.
We are going to start with what stock are we starting with?
DuPont DD.
DuPont DD. Let's jump into that one. So again, the 10 and 10 is a chance to break down 10 stocks from a technical perspective and break it down here. I'm going to go to a daily chart for these guys. So DuPont is one of those charts. This is out of the materials sector. Boy, materials is one of those that we love to not pay attention to until it becomes really meaningful. And something like DuPont is testing its 200-day moving average from below. So as a trend follower, I have to see the fact that this is in a cyclical downtrend. We're testing resistance from July. And so I think this level we're at right around $74 is really, really key. Until we're able to muscle through there, I think you have to just be skeptical. You have to be a cautious bull at this point, but we are right at the turning point. And I think a close above 74, a close and a confirmation above the 200-day moving average, I think this is the kind of name you could be really interested in for the long term. So something that has tested support very nicely, rotating higher, a break to new cyclical highs, new interim highs would show you that bulls are starting to take control. Buyers are starting to come in. So a really interesting chart to watch specifically for a break above resistance and a break above the 200-day moving average.
Okay, and next up would be XBI.
Thank you so much. Biotech stocks. Thanks for the question on biotech. So the XBI, boy, biotech has been one of those really frustrating groups. And again, at times, I think all charts are frustrating, but biotech in general, right? There are times when biotech has been fantastic leadership. It's been the group that if you're not there, you feel like a total idiot. And I get it. The first quarter of this year, this is the, leading out of the lows. Look at the great rally out of the December market low. Look at the bottom of the relative performance, how that turns up as the XBI outperformed the S&P 500. But since then, boy, as the market has held up very, very nicely, look at how biotechs have been underperforming. That's the relative chart on the bottom, looking at the XBI relative to the S&P 500. We have this pattern of lower highs, lower lows. So for me as a trend follower, I am dying to get a higher low. That is my kingdom for a higher low. When you see that, when you see the the XBI pull back a little bit, you see buyers come in, you see it able to pull up a little bit. I think that's where you want to get into it. Arguably, that is happening right now. And I love what we're seeing right now where it's testing the moving averages. We have what's called a bullish engulfing pattern. Usually happens at the lows, but we're seeing it now. If we close around this level, that's a really good short-term bullish sign for the XBI. This trend line coming off the highs is going to be really important. And I'd be watching for that, a break of there. And I think it's much further skylight above there.
Okay, and next up is CPG Crescent Point.
Awesome. So this is out of energy. I was wondering, I was actually taking a guess as to how many energy stocks we would get today. So thanks so much for the question. I mean, energy stocks have been such a snoozer and such a happy to ignore type of group for the longest time. And look at how this has just been down at the previous lows. So much of that has changed so quickly. It's now rotated. And I like where you have accumulation. I like when you break above moving averages. And I love when you break above resistance. This, in my opinion, is a long and strong type of pattern, breaking to new highs. What's key about this specific chart, CPG, is we are extremely overbought. It's an RSI above 80. What that suggests to me is short-term pullback and a very buyable pullback. So I think it's a really compelling chart right here. Good question.
Okay, and following up with that is APA, Apache.
Another energy name, another E&P name is actually in the same group here. So you'll find a lot of these have very similar patterns, and that's fine. And again, the question is, Do you jump all the way in? Do you jump in with like some sort of industry ETF or something like that? Do you just buy the biggest names? Or do you try to be more of a stock picker and pay attention to it? What you're going to find with a lot of these energy stocks, they're going to become overbought if they're not already. Many of them will become extremely overbought. What's interesting about Apache, though, is you can see compared to the previous name, CPG, you can see how this one is actually rallying into a significant resistance level, not yet eclipsing the moving averages. The moving averages are still sloping downwards. So in my opinion, I think all of these are compelling here. And on a pullback, the real question with these stocks is at some point, even tomorrow, they will start pulling back a little bit, digesting this huge gap up. And you want to see where they pull back to. And again, assuming it's a higher low, I think it's a really interesting group and a really interesting stock to pay attention to. And again, I love the fact that it's off a lot of people's radars, probably until today, everyone.
Okay, and following up with that, another energy, it would be PLUG, Plug Power.
Perfect. So this is a little different type of name. It's more of a renewable energy name, which is of interest. So, same sector, but what I would remind you when something like this happens, when oil stocks jump and when the market is doing one thing, don't get too caught up in just the sector. Remember, even energy, which is pretty concentrated with the big integrated names, Exxon, Chevron, with the E&P stocks, with the producers, there are also some renewable energy names in there that give you a different return profile. So it's worth taking a look, screening through the stocks, even looking at the scooter rankings and seeing what bubbles to the top. Plug in particular is a really interesting chart. You can see how it's rallied so quickly up to resistance. It's hard for me to want to buy on a day like today because it's gone so vertical. And you can measure that in a number of ways, but it's right at resistance. It's extremely overbought. And again, what that means for me, if you look back at the chart in March, you can see how it became extremely overbought after a huge run up. It came back a little bit. It became overbought a little again, but at a much lower level. And that ended up being the entry point when we came off of that extreme overbought reading. So that's the pattern I would be looking at on a chart like Plug. A day like today, when it goes vertical, it's up over 5%. Tough to buy into that movement. Stocks like this tend to pull back once people are really excited about making money and are okay digesting it a little bit. There might be a better point in the near future.
Okay, and then next up is finance, OMF, One Main Holdings.
Thank you for a different type of stock here. Let's switch gears mentally, looking at a consumer finance name. This is OMF. So you look at some of the other stocks we've been paying attention to. Look at how this has actually established a lower high almost. So we had this huge run up in July. This thing really went vertical, outperformed. Look at how it jumped up, outperformed as the major indexes were sort of stabilizing, establishing that high. This is something that gapped up, I'm assuming, on an earnings beat. In financials, you have a lot of really compelling charts right here, and a lot of the regional banks, to be honest with you, emerging as really interesting long-term charts. U.S. Bank, I'm just coming out of nowhere thinking of KeyBank, for example, right? Stocks that are really starting to emerge, coming to new swing highs. This is one that is actually below its previous highs, so it makes me a little more concerned. As a short-term investor, I like how we've rotated above the previous high from mid-August. So I like that short-term rally. In the short term, it's kind of compelling, but I don't like the fact that we have this huge resistance level to pay attention to. Also, a lower high in the RSI. So, in my opinion, in financials, there's some other groups that might look a little more attractive here, but overall, not bad. There are much worse charts out there. Don't get me wrong.
Okay, and then this next one we actually were discussing this morning, CMCSA, Comcast Corp.
Boy, the cable companies have actually looked really, really good. This is a part of communication services that has emerged really nicely. So other names in this group are actually in really good long-term trends. This is the type of chart you'd really like to own. Over the weekend, I look at all the S&P 500 charts and go through them one by one to just try to pay attention to them. And what I caught on all of them is sadly what we're seeing today, which is they were all right at that overbought level. And Comcast, maybe the best clear example of that, looks strikingly similar to what we saw in mid-July, going to new highs, but overbought. That's okay for the long term. All that means is you're going to have to probably come down a little bit. And that's what we're seeing right here today. So overall, this is a pretty healthy pullback. And boy, you'd love to be able to buy a name like this as it pulls back to something like the 50-day moving average. So long term, the trend is really positive. On a day like today, I think you wait a little bit, and I think we're going to have a little more viable levels in the short term, perhaps.
Okay, and next up is WDAY, Workday Inc., and that's a technology.
Wow, Workday, right? So this is stocks in the news are always interesting. This is one that a lot of people are debating. A software company, WDAY, and again, for me, I like uptrends. I like stocks that are seeing higher highs and higher lows. I tend to avoid downtrends, which is lower highs and lower lows. So as a trend follower, it is hard for me to buy into this sort of name at this point, because all I'm seeing, ignore what's happening today, look at the long-term trend, and you see this pattern of lower highs, lower lows that has been confirmed. And if I would draw a trend line on here, I'm not going to do it, but just for time. But if you would draw it, taking these highs, that puts us right around here, 180, 185. We break above that level, that would sort of reverse this downtrend. But as a short-term mean reversion trader, if that is how you would describe yourself, I think this is a really compelling chart in the short term. Might be worth a shot, because this bullish engulfing pattern is sort of candlestick 101. It became oversold, new lows. You'd have a lower open, you rally. And again, if we close around these levels, it could be a really interesting type of chart to buy later in the day today and ride a short-term rally. Most of the time, you would rally from this point.
Okay, and next up is LHX, L3 Harris Technologies.
All right. This is a name I'm less familiar with, and it's in industrials. And I love stocks that I'm not familiar with. And I would tell you, one of the best things about charts and using the scanning engine on a place like StockCharts is you will surface names you're less familiar with. And overall, I would say this is a really compelling chart. I like the rally as the market has been volatile, as the market has been up and down. Look at how this has just been a consistent uptrend, higher highs and higher lows in the industrial sector, which a lot of people are not paying as much attention to. Recently pulled back, and look at this nice rally last week as it tested the 50-day. I think this is the type of chart you'd love to buy on weakness and play into the long-term uptrend. Good chart.
Okay, and the last one is BF/B / Brown-Forman Corp.
Brown-Forman. Yeah, this is a Staples name. Really good question. And my short answer on this one is I love this chart. I love these names in consumer staples. I've been talking to people about these only because they show long-term strength. They've had a nice rally, a nice run. They became extremely overbought. What you wait for there is a short-term pullback, and it usually ends up being pretty buyable. I would argue a day like today might be the time to consider it. I love the long-term trends, and again, in the consumer space where there are a lot of really challenging charts, something like Brown-Forman I think can be a really compelling one. So, really good question, and I would agree that's an interesting one.
Okay, so now we're going to go into the mystery chart reveal. We do have a couple people who wrote in a guess.
Excellent. Can I hear some of the guesses? Can you share them?
So we have 2 votes for SO and 1 for LMT. So that's Southern Co. or Lockheed Martin.
Really, really good guesses. Bonus points for everyone for guessing. Thanks so much for sharing that. And the good news is 2 of you were absolutely right. And I'm going to assume we were all good people. We did not go and cheat and look for something random on StockCharts. I'm going to give you the benefit of the doubt here. But overall, listen, you're absolutely right. This is Southern, right? And this is a utility stock. This is what the chart looks like. And I forget what actual chart I took the screenshot of, but this is the daily chart I'm looking at. The reason why I brought this up, and I didn't know, I had not looked at the poll responses, but I couldn't help but notice that utilities were the last in line for most of you, or you're definitely overall, none of you picked utilities as a leading sector. And what's frightening about that, or not what's frightening, I mean, that's a fair answer. I don't blame you for not thinking of utilities as your go-to. But if you end up being a little more cautious, if the things that have been working start to struggle, if the old leadership like tech and consumer communication services, if those sort of names start to roll over a little bit as the market hits resistance, if we're looking for opportunities for long-term winners, if you look in utilities, you're going to find long-term charts like Southern. And SO is a stock you probably don't look at a ton. And the other names in that same group in utilities, you probably don't look at as much. And I would encourage you to do so. Make sure when you're screening for ideas that you include utilities and include real estate, because a lot of REITs look kind of similar to this. So they're interesting. What's really compelling on this, if you look at the chart of Southern, we'll talk about the chart in a minute here, but look at the yield here. So this is something that yields 4%. And again, I know we're having interest rates fluctuate. We may see dramatically higher or lower rates in the near future. But I tell you what, anything that yields you 4%, that's what your dividend is going to pay you. Not too bad. I have a savings account. It does not pay anywhere near that. So if you're parking cash somewhere, Some of these higher dividend payers are really compelling. So something like Southern is one that I encourage you to do it. Now, how do you find names like this, right? How would you know that something like this is happening? What I encourage you in your screens, look for stocks that are performing well. One of the screens I look at all the time are new 13-week highs, new 13-week lows. You can also do it as like 65-day highs and lows. I love looking at that screen, and what happens, forget about the sector, just do it based on the price movements, and then organize it by sector. That's how I do it in the scanning engine. What that does is when I get to utilities, I start to see all these utility names pop up. And in all sectors, you're going to find stocks making new highs and lows at any point, really, right? Most of the time, there are stocks in each sector that are sort of at the outliers that are moving up and moving down. But what a screen's going to do is surface a name like utilities, and like Southern, which is in the utility sector. And when you see more and more utility names on your list, that's when you want to start thinking a little more defensively, I would argue, big picture, because what it tells you is that institutions, the guys running a lot of capital that can move stocks up and down in a meaningful way, they're rotating to some of these more conservative stocks, and that's where you want to be. Broadly speaking, and generally that's where you want to start to think about. Other names that sort of fit in this defensive theme. It's the traditional telecoms like AT&T, Verizon. Now, again, more and more, those names mean a lot other than just traditional telecom. I know they have a lot of other products going on, and AT&T jumped in the last couple of weeks with an activist investor coming in and making a lot of discussion about what AT&T, how it will evolve, and support from the management team. That's outside of the scope of MarketWatchers Live. For the most part, but looking just at the charts, look at how this has rotated. This is AT&T now, ticker T. You can see how telephone was selling off into the market lows, stabilizing sideways pattern, and then rotating this period of accumulation. That's continued. Now, a lot of these names, like others, are correcting today, pulling back a little bit. That's coming out of that extreme overbought level. But overall, this is a pretty healthy relative performer. Look at how the relative performance has emerged toward the end of the summer months, going into August and then into September. Same thing as a yield play. This is yielding 5.5% at the weakest point when the price was down here. I want to say the dividend yield was almost 7%. It's probably 6.5%, if I remember right. So I mean, this is something, and again, that's because it's based on the price of the stock, obviously. So what are you getting paid out as a dividend relative to the price? So what this is telling you is that, for $1 you spend, you're getting 5.5 cents back every year in the form of a dividend, which isn't too bad as a defensive play. So for those of you that did not pick utilities, again, you may be right. I don't want to say you're wrong for not picking utilities, but I would remind all of you, if you have not paid attention to the defensive side of the ledger sheet, pay attention to stocks like Southern, also something like AT&T, other names that you'd consider in that. Forget about it. Don't think about it. Buy and hold type of category. They actually might be really compelling charts with really compelling dividend components or total return components that you want to pay attention to. Just to wrap up very quickly this discussion, and then we're going to wrap up this show. This has been a fantastic hour. I wish I could do this every day. Very soon I will do this, and we'll rotate it to more of the closing bell. But I can't tell you how much as an investor this helps. As a technical analyst, this helps so much to look at charts and force myself to have things to share with you, because what it does is it helps me to stay honest, looking at the charts that are of interest to me every day, and also making sure that I'm on top of the themes of the day to pay attention to you. Since we've been shooting the show here for the last just under an hour, the S&P pretty much where it was. We're just below 3,000 at 2995 or so. And again, the main thesis I would share with all of you, and again, on a day like today, when you have energy, oil jumping so dramatically, if you weren't there, that's okay. There are plenty of movements to pay attention to going forward. It's all about paying attention to the price movements. And right now, stocks down a little bit. Again, energy, oil up pretty good. What concerns me with the S&P 500 is we're in this congestion area. We're in this level of resistance where I'd be a little concerned as a short-term, as a long-term investor. Didn't mention this earlier, but I think it's also important to notice the RSI on the broad market. The fact that it's just below 60, actually just bumped above 60 here. And in a bear market phase very quickly, that's where you'd expect the market to rally to before the next leg down. So that, as we approach resistance and the RSI peters off around 60, boy, that's not encouraging as an investor here for short-term strength of the market. Just to finish off here, I want to check back in on the sectors and just two charts to leave you with here today on Monday the 16th. Number one, looking at consumer discretionary versus staples. Again, we're testing resistance there, testing the long-term averages. I want to see if that continues higher, if that rolls over. I think that'll be very telling for the long term and understanding where the leadership has come from. Energy is our final sort of check-in on the equity markets here today. Rallying a little bit actually since the noon hour. So looking at to see if we close near the highs or near the lows where we're at here is going to be pretty compelling. Thanks again so much for joining us. Just want to check in on the schedule going forward. We got some really good presenters. Dave Landry I have on Wednesday. I'd encourage you to focus back in for that. As always, we have a survey going, and I'd encourage you to respond, especially for me trying to learn how to do better for you. Thanks so much for joining Market Watchers Live. Thank you.